Hello, I'm Jean Medeiros, the Director of the Pension Action Center at the University of Massachusetts, Boston.
And I am Emily Brown, Staff Attorney at the Pension Action Center.
Today, as part of our Investor Education Initiative, we'll be speaking to Glenn Frank, a personal financial planner at Lexington Wealth Management and professor at Bentley University in the Graduate Financial Planning Program. Glenn's been both a practitioner and an educator for over 25 years. He was listed by Worth magazine for 10 years in a row as one of the top financial advisors in the U.S. Professor Frank's been quoted many times in the Wall Street Journal, Reader's Digest, Investment News, Boston Globe, and other prominent media outlets. Thank you so much for agreeing to be with us today, Glenn.
My pleasure, Jean. I'm absolutely honored to assist the Center in this very worthwhile initiative. Let's start with a quote from Plato. The beginning is the most important part of the work. So procrastination has been around for thousands of years, and this stuff really isn't that complicated. The absolute key is to simply get started. There are just 3 basic steps. The first step is financial planning. How does this money actually fit into your life? How much of a return do you really need? Second step, asset class selection. To accomplish the financial planning needs, how much in stocks, bonds, and/or cash is the question. This will have the largest impact on your returns. How much in higher returning but riskier stocks? How much in lower returning, lower risk bonds and cash? That's the big question. Third step, asset class capture. How are you going to actually invest? Are you going to buy individual stocks and individual bonds, or smarter, safer, easier mutual funds or exchange traded funds? For example, if you decide that 10% belongs to emerging market stocks, how are you going to do it? You should probably buy a mutual fund or an exchange traded fund. Let's elaborate on all 3 steps. Again, the first step was financial planning. Most of us need a cautious growth approach. So how much risk do you have to take to get through life financially? There are some very helpful calculators out there. For example, the AARP calculator is referenced in the Pension Action Center's website. There's a nice link there. It's fairly easy to use. And if you use it, it should point you to an appropriate mix of stocks, bonds, and cash. It will look at your entire situation. It'll take a look at your spending, your other assets, your other sources of income, whether you're collecting a pension, Social Security, whatever. Note that if the return you need is too high, you may need to reduce your living expenses now before you are forced to later. You can see that there's a huge difference in accumulation over time between earning 2%, 4%, and 6%. So this is $10,000 growing for 20 years at those various rates of return, and again, much larger accumulations with the higher returns. Okay, Einstein has many marvelous quotes. One of my favorites is, compound interest is the most powerful force in the universe. So here's a pretty smart guy. If he was alive today, he would probably tell you to invest early, invest often, and to somehow get higher returns. Which means unless you're the first human being ever born who can successfully and consistently time markets, what you should probably do is have part of your portfolio always in a well-diversified group of stocks. And by all means, keep a long-term perspective. Do not watch the portfolio every day. CNBC is not a good idea, honestly. It'll drive you crazy and cost you money. There are lots of seemingly brilliant people out there that appear to know what's going to happen tomorrow. They really don't.
So in light of that, Glenn, can you describe what it means to diversify your retirement portfolio?
Perfect segue, Jean, to step number 2, asset class selection. Good news is there is some free lunch, and that free lunch is being diversified. Why do you think the big endowments like Harvard and Yale and big pension plans are so broadly invested across the globe? They're not trying to guess which area of the world will have superior returns next year. They have no idea either what will happen. They do understand, however, by buying investments that do not move in lockstep with each other, that maybe zig while the others zag, that over time the ride will be smoother and the compounding will be greater. I love this chart entitled Why Diversify. The earlier chart assumed a static 2, 4, or 6% rate of return, same rate every year. Unfortunately, that's not going to happen. Returns will in fact fluctuate. In this example, there is a $10,000 invested over 20 years. Under A, the return pattern is 0% year one, 10% the next year, 0% the third, 10% the fourth, and so on. This pattern goes on for 20 years and accumulates very nicely to $25,939. And I've labeled it the smoother ride. B, however, is much more volatile. B loses 10% every other year and makes a positive 20% every other year. Note that they both have the same average rate of return of 5%. But B, the rocky road, only grows to $21,589. So the benefit or the free lunch associated with the smoother ride is substantial. It's about 20% more money, $4,350, plus the big plus is you're better able to sleep at night.
So Glenn, what's the best strategy for someone to do that?
Good question, Emily. That nice transition to the third step, asset class capture. So now it's time to actually invest. So for example, if your calculations say you should have 50% in stocks, how you can actually do that? As I noted earlier, funds probably make the most sense. Funds basically own a small portion of many, many securities. They're a lot easier than buying individual stocks. Plus you eliminate single stock risk. Anyone remember Enron? Also, as a basket of stocks in a fund will be less volatile than individual stocks, you'll get that compounding advantage we noted before. Realize that the likelihood of a large compounding killing loss is far greater with single stocks than a fund. You can lose it all with a stock, but not with a fund. Another point when you're capturing your asset class is you should pay close attention to cost. For example, you probably don't want to pay a load. That's a commission to buy or sell a fund. And you need to understand what the operating expense ratio is of the fund. You may not pay this internal management cost directly, but it does come out of your money and it will come out of your returns. You saw the compounding chart before. I think a lot of people are blowing an extra 1% or more in investment cost, and per the chart, dropping 1% has serious long-term implications. So what do you do? Well, I agree with Warren Buffett, who says most investors are better off with index funds. So what's an index fund? It's a fund that simply buys whatever is in the index. For example, if you're trying to capture large US stocks, an index fund might simply buy the entire S&P 500, all 500 stocks. If they're trying to capture emerging markets, there's an index for that. There's indexes for bond funds, international, domestic. There's indexes for everything. Note that exchange-traded funds typically just follow an index. So pretty much not all of them, but almost all of them are very inexpensive as a result. Mutual funds, on the other hand, are usually paying for all that research. They're active traders, so the majority of mutual funds are more expensive, and again, it's an active trading research strategy. Although some mutual funds are index funds that again are low cost. Over time, the index approach should win, again due to the lower cost.
Can you describe the difference between getting a total return versus a total yield on your investments?
really a critical question, Emily. There are lots of investor traps to avoid. The one you're referring to is what I call the yield trap. People really should think total return more so than yield. For example, let's suppose you go to the AARP calculator and it points to you need a 4% rate of return. And maybe you're afraid of the stock market. We all remember 2008. And you figure, well, if I can get this investment over here that has a high yield, 4%, either some bonds or high dividend paying stocks, I've got it covered, I'm good. Well, you can't get that kind of a yield without taking risk. In fact, there's so many things in our industry that sound right that aren't. I want you to have a total return focus, not purely yield. If there is a higher yield, then there must be higher risk or less likelihood of growth. Another trap is the chasing performance trap. So the quote that's relevant is, "The road to investment hell is paved with past performance." If some investment has done really well of late, that is exactly the reason to be careful. Why? Because there's a tendency for mean reversion. Throughout history, bubbles have always eventually burst. For example, U.S. equities have done very well since the market fallout in 2008, all the way up until last year. International emerging has not done nearly as well. This can easily reverse. You don't want to put all your money in one economy. It is all really quite unpredictable. So stay invested in all these things. Another trap, the "I can't take it anymore" and bail trap, when in fact you need to be Rip Van Winkle. History has shown over and over again that the average investor gets a much lower rate of return than what the general markets earn. Why is that? Well, it's a lack of discipline. It's human emotion getting in the way. Smart investing says buy low, sell high. Human emotion says just the opposite. Human emotion says buy high, and sell low. To buy when everything is going well, like it will stay that way forever, and to sell when things are gloomiest. So once you have an established portfolio, largely ignore it. Rip Van Winkle would have been a marvelous investor. He would have slept through all 20 years. Another trap. The advisor is planning for themselves and not yourself. If you are uncomfortable handling your own investments and need to work with an advisor, make sure you understand how they're getting paid and what conflicts of interest they might have. Pension Action Center has a really marvelous fact sheet on choosing an advisor. I strongly recommend that you take a look at it.
Great. Could you tell us more about target date funds? Do they help with diversifying, rebalancing, and having more of a long-term perspective?
Certainly can, Emily. Target date funds are perfectly on point, and I think investors who use them will probably be in the upper echelons of results over the years with very little effort.
So Glenn, another challenge that people face with these is figuring out a withdrawal strategy once they have retired. Can you speak a little bit about how much a person can withdraw each year and not run out of money?
Gene, that's the million-dollar question all the baby boomers are asking today. What I hear most is 4% in the profession. That the average investor should be able to take out about 4% each year, and factoring living expenses going up with inflation should be okay. So for example, say you're 65, you have $100,000 in your retirement plan, and you're going to invest reasonably, you're hopefully paying attention today, and you should be able to take out $4,000 a year in purchasing power for the rest of your life. And that'll be part return and part principal. What you're really trying to do here is pull off the perfect financial plan. And that is, over a lifetime, bouncing one check, and that's to the mortician.
Thank you so much, Glenn, for coming here today and sharing your knowledge to help individuals to hopefully pave the way toward a financially secure retirement.
We hope you found this information helpful, and please visit the Pension Action Center at www.umb.edu/pensionaction to view additional information on planning for your retirement and to learn how we've helped thousands of retirees obtain their pension benefit. Thank you.